Hello and a warm welcome to each of you joining us today. You're tuned into the first virtual version of this kind of event, the Independent Insights Webinar 2020. Now, this is a virtual event that sees three of the powerhouses of investment in South Africa come together to share information and put forward strategy. My name is Gugulethu Mfupi, and I have the pleasure of being your host and facilitator for today. And I look forward to unpacking some pertinent and critical issues that we need to discuss that are relevant to today's webinar. Now, for many of you in the investment community, this event isn't particularly new to your calendar. Allan and Prudential partnered together to run this event successfully for 3 years before extending it to include Nedgroup about 2 years ago. Now, the investment insights delivered by these three leading investment institutions in South Africa have ensured that this particular event has become a hot ticket item for many participants and advisors and central decision makers in this particular sphere. Now, together, these three brands aim to create a platform to share thought leadership, providing in-depth commentary on industry-relevant investment themes. Now, previously in a world pre-COVID-19, this particular event was rolled out in a series of roadshows across various cities in South Africa. But if we fast track to the last five months of our lives, many of us have adapted to this virtual environment where we incorporate working and operating remotely. And this in itself has provided Allan, Prudential, and Nedgroup the opportunity to extend this particular offering to a much wider audience of participants. As such, I'm actually told that the number of participants we have here boasts the most number of combined attendees at an Independent Insights event ever. So we're making history here, ladies and gentlemen, right in the middle of a global pandemic. With that said, we'd like again to extend a very warm welcome to each and every one of you joining us from your various locations and jurisdictions. Now, talking about history as well as how things have changed, we've certainly seen a lot in the headlines that laments the low growth environment that we've witnessed in South Africa, from an economic point of view, as well as investor return. All of this while facing the backdrop of a continued uncertain economic and political environment, both globally and locally. Many investors are probably feeling very despondent and just simply uncertain about the prospects of receiving a return in this particular investment climate. And this leads us to the pertinent theme for today's webinar: making the most of investing in a low growth world. Are poor investment returns inevitable? Well, I've had the opportunity to speak to a few of our guests that will be joining us today, and I can assure you that the response they've given me to this very difficult question is a resounding no. And we today will have the opportunity to deep dive into understanding what their reasons and, of course, understanding of this particular investment environment are behind their response. Now, quite clearly, we're going to unpack the current rhetoric that we're facing in terms of the local and global economic dynamics and, of course, unpacking the prevailing market conditions. The most important element that we want to emphasize today is how best as investors we can maximize our investment returns while being cognizant of minimizing risk that exists in the market. This by exploiting the possibilities at hand and managing the risks in this post-pandemic environment. Now, I'm not going to host this conversation all by myself, but I'm glad that I have a set of three guests, industry experts with a wealth of experience within the investment arena, who'll be setting the tone for this conversation as we kick off by starting off with a panel discussion where they'll address some key elements and concerns that have been raised, and thereafter we'll deep dive into a Q&A session where your participation and engagement is called upon. So please do make use of our live chat facility on the streaming platform to pose any of your questions and comments to our panelists. Following our discussion, we'll be able to address these, which will be moderated in the background to ensure that themes that are aligned and topics of a similar view can be addressed appropriately to our panelists in response to some of your questions. Well, to kick us off, we're going to deep dive into a few questions to establish the landscape of our conversation. Following thereafter, we'll ensure that we address some of your questions, time permitting, of course, and ensure that the appropriate panelist can best respond to the themes and concerns that you've raised. Today's conversation really looks to provide investors with some insight as to how best we can all maximize return, but being cognizant of minimizing risk. Now, this leads to many questions and many moving parts, and as a result, we really call for active interaction and engagement. As such, I'll be joined by three esteemed panelists with a wealth of experience within the investment arena who'll be engaging us in some of the more deep and concerning issues that we'll address today. But we also want you as our viewers to participate. Share your questions and comments with us through the chat facility, and these questions will be moderated and addressed at the end of today's panel discussion. However, without further ado, allow me to introduce you to our speakers who will be giving us some insight into key industry topics and trends that we all are quite keen and aware of. Our first panelist who joins us today is Jacques Plout, Portfolio Manager from Allan Gray. Jacques joined Allan Gray in 2008 as an equity analyst after working as a management consultant. He began managing a portion of client equity and balanced portfolios earmarked for associate portfolio managers from March 2013 and was appointed as a portfolio manager in November 2015. Jacques holds a Bachelor of Science degree in mathematics from the University of Cape Town. My next panelist is Ian Power, Portfolio Manager at Truffle Asset Management. Ian completed his BCom Honours in Investments at Rao University in 1992 and started his career in investments at RMB Asset Management in 1993. Ian has held various investment roles at RMB AM, including being a member of the board of directors, as well as the management board, while being a senior investment professional in the equity team. After 16 years with RMB Asset Management, Ian joined Truffle Asset Management team as a portfolio manager in May 2010, who together manage the Nedgroup investment balance funds as part of the Nedgroup's best of breed philosophy. My next panelist joins us, Sandile Malinga. He's a portfolio manager at Prudential. Sandile joined Prudential in 2013 as a member of the fixed income team and later joined the multi-asset team in 2018. He's the co-portfolio manager of several Prudential funds, including the Prudential Money Market, Income, High Interest, Target Income, Inflation Plus, and Balanced funds. His role involves providing analytical and economic support into the multi-asset and fixed interest investment process. He's also a member of the Prudential Asset Allocation Committee. Sandile holds a BSc in Mathematical Statistics and Actuarial Science and is a student member of the Faculty of Actuaries and has 13 years of industry experience. Now, ladies and gentlemen, please allow me to warmly welcome each of our panelists who are joining us in conversation today. Ordinarily, on a normal stage, there would be a resounding sound of applause, but we acknowledge that technology will provide other forms in terms of acknowledging our audience who are present with us today. Well, let's jump straight into conversation and really address some of the pertinent and challenging issues that many of our investors are facing. And Jacques and Ian, I'd like to address this question to the both of you. We currently see the large majority of the South African audience falling into this bucket of anxious investors. Everyone's uncertain as to how to ride the market volatility in the short to medium term, some considering holding on to cash, others considering if they should hold on to bonds. But there's a clear level of confusion and uncertainty. Jacques, to start off with you, what would your advice be to investors as to how best to manage this volatility in the short to medium term?
Thanks, Gugu. I'm actually one of those anxious investors. There are a lot of crazy things happening in the world right now, and there's a lot that can go wrong in the next few years. And to make it even worse, I don't even think cash and bonds are necessarily a safe hiding place, even though they're tempting. Because remember, when you're buying a bond, what you're doing is you're lending money to the South African government. And the first question you ask when you lend money to someone is, can they pay you back? And the odds of that being paid back over the next 5-10 years have decreased quite a lot because of the huge blowouts in our deficit, because of our response to the pandemic. Now, having said all that, at least a huge amount of this stuff is priced in at the moment. So the time you need to be really anxious as an investor is when growth expectations are really high and stocks are priced for perfection. But at the moment, actually, when we look at it, bonds, equities, they're all already priced for quite a severe down scenario or not much growth over the next 5 years.
Ian, your thoughts?
Thanks. I think from a sort of a bigger picture scenario, I mean, as Jacques has alluded to, there's a lot of uncertainty, and there's always uncertainty, I guess, from a macro and from an investment perspective. But I think the key in terms of investing and understanding, your objectives is to, ultimately try and buy into assets at appropriately cheap prices, whether it's a bond or whether it's a property stock or an equity. And I think ultimately, if you're paying the appropriate price with a decent margin of safety, ultimately that will translate into probability of not losing capital, which I think talks to the anxieties that SA investors are facing. And then secondly, increases the probability of generating real returns. So I think, it's very difficult to call markets in terms of market timing. There are lots of exogenous factors at play. And I think the most important thing to keep in mind is to stick to the process, and certainly from our perspective as asset managers, of trying to buy into assets at prices which are significantly below what they are worth. And ultimately, that is what is going to protect you over time and increase your odds of being able to generate the real returns that all our investors need, to meet those future liabilities. And I think, from a cash and bond point of view, whilst it is tempting to try and go into, some of these, let's call it safe haven investments, often what happens is you go into them at precisely the wrong time. So it's that part of human psychology and the human emotion that pulls you into the safe investments, significant opportunities presenting themselves in the other risk assets. So I think, having said that, my message to, I guess, investors is to understand the value that you're buying into, understand the prices that you're paying for those assets, and as long as you're buying into them at the appropriate discount or margin of safety, you then have the comfort of riding out what is going to be, I think we all acknowledge, a pretty volatile and uncertain future.
Thanks for your feedback, Ian. I think quite great to see how calm you are approaching the anxiousness and anxiety levels within the room of investors that we joined by. But as you mentioned, identifying the right asset classes at the right value is really something that is determined by the environment that we operate in. And to address the elephant in the room, particularly for domestic investors, has to be the structural reforms that we are waiting to be implemented in South Africa. 2020 has certainly dealt a blow for our macroeconomic front on so many levels. The shock again and downgrade that we saw from Moody's, the response we saw from National Treasury in terms of a document to try to motivate and stimulate for structural reforms, the South African Reserve Bank as well pumping more capital into the system, including sharp cuts in interest rates. There are many and plenty moving parts, but the question is, what are going to be these appropriate structural reforms that will translate into greater economic growth and, as such, greater investment opportunities for South African investors? Sandile, maybe I can throw this hot potato at you.
Yeah, sure. Thanks, Gugulet. I think one of the issues with South Africa is the fact that South Africa is actually probably one of the best analyzed emerging markets in the world. So we've got a whole swathe of plans. It's been 10 years since the National Development Plan was actually adopted by Parliament. So, in my opinion, we have enough plans. The most important thing right now is for the government to actually start with something, okay? Pick any of the things that need to be done and just do them. Deliver them. And we live in the real world, so no one ever imagines all of the reform initiatives that need to be addressed and actually undertaken will be perfectly executed. But if you don't shoot for something, you miss 100%. So, we can't, wait another 6 months for another plan. We have enough plans. Our plans are actually very good. from a policy-making perspective, I think we actually, punch well above our weight in the world. The World Bank, has said that, in their structural reform assessment of South Africa, that South Africa's plans are actually probably some of the best boilerplate plans you can find. So, if we don't start, we're just not going to get anywhere. And you can see that the world has actually lost patience with South Africa. I mean, you can name a number of examples. Foreign ownership of domestic bonds, has fallen 12 percentage points from 42% to just over 30%. That's at the end of July, over the last sort of 15 to 18 months. And that tells you something. As you mentioned, Moody's has already downgraded South Africa earlier this year. And that tells you that, ratings agencies have actually lost patience with South Africa. You speak to ordinary South Africans. I mean, there's a number of surveys, where they ask people, do you think the country's going in the right direction? And it's quite stark to actually think about it, that the number of people, the proportion of respondents who think the country's headed in the wrong direction is as high as it was in apartheid. So, I mean, that is, that's scary. You can't really pinpoint a specific, intervention that will have, quick fixes, but we just need to start and get on with it.
You say it's difficult to pinpoint a particular intervention, but I want to push you into a corner here further, Sandile, that if there were any specific interventions that would stimulate significant economic growth for South Africa, give us about one or two options at least.
Well, I mean, the immediate intervention, which is quite nebulous, is to restore confidence. Okay, people are not going to invest in the economy if there's massive amounts of uncertainty. You're not sure what the regulatory environment's going to look like in 6 months. So, we say things like you need to provide a regulatory certainty, you need to provide actual sort of policy certainty, and that goes a long way to allowing people to actually start planning and seeing whether there are investment opportunities in the economy that they can undertake where they will actually earn a reasonable rate of return. Because ultimately, if you're asking people to commit their capital, you need to provide them with some return for the opportunity cost. And I think sort of longer term, you look at things like the unemployment rate. Youth unemployment is probably over 60% now post-COVID. You just simply can't have people who just don't have the skills, don't have the level of education that's needed to participate meaningfully in this economy. So, I mean, we've already lost probably a whole generation of youth who have been poorly educated. The one intervention that will certainly go a long way to addressing the key structural issues in South Africa would be to fix education. But that is a 10, 20-year plan.
Definitely all about the long game. And speaking about the long game, that's always suggested, right, when it comes to investments. But for South African investors, the last 5 to 7 years, we've actually seen mundane economic growth, pedestrian returns when it comes to our investments. And that, again, might be exacerbated at the moment, given the very bleak outlook for South Africa's economic growth trajectory. And then, which might also translate into the concern that we might see bleak returns as well from an investment point of view. So here's an open question to each of you as panelists, and I'd actually like to throw it to you first, Ian, to get your feedback. Is it not better then for South African investors to perhaps put as much money as they can offshore in order to pursue heightened returns? How do you analyze this particular environment at the moment?
So, Gugulethu, I think what we try and do is we try and understand what expectations are being priced in to various assets. And I think, the South African equity market is certainly homogeneous in the sense of the businesses that we have listed here. Many of the businesses, in fact, are, decent offshore quality businesses with decent franchises or business models, strong balance sheets, and are certainly very, very sustainable. But I think the biggest impact that we've seen from your question, the fact that under the Zuma administration, we've really seen GDP outcomes in South Africa starting to trend on to the extent that, for the last few years, we've actually had negative GDP per capita growth. So, what does that mean? It means that on a per capita, per person basis, people in South Africa have been getting poorer. And I think that sets a difficult backdrop for South African businesses who have to generate their earnings and income from doing business in the South African context. And I guess excludes many of the big, of those big global businesses that I've already referred to. So I think when we look at those businesses, I think the first observation, share prices are significantly lower than what they were in the past. And I think by definition, if all things are equal, that would represent an opportunity. But I think as you've heard from what Sandile has said, and I think, looking at your implications of your question, is the South African economy is moving into a space where, dissimilar, I guess, to typical emerging markets, which display, higher than average growth outcomes, and, emerging markets by definition saying that you've got emerging consumers, and as they get wealthier, those spending habits then translate into, better profitability for certain businesses. And we, in fact, from an SA context, are in exactly the opposite, framework, to the extent that our growth outcomes are deteriorating. Many of Sandile's comments insofar as political uncertainty, policy uncertainty, and all the issues affecting us are meaning that businesses are facing almost a perfect storm of not being able to recover the cost increases in their own businesses in an environment where they are unable to generate or participate from higher levels of economic growth, which is resulting in lower returns on invested capital and, effectively lower growth expectations. And I think that's probably one of the biggest factors that's troubling us, because as investors, we all try and take advantage of mean reversion. And I mean, mean reversion in its essence is trying to buy into a business which is going through a temporary setback. The setback could either be company specific or from a cyclical perspective, but the fact of the matter is temporary implies mean reversion. And I think what we're seeing in the data from an SA perspective is there's a lot of data to suggest that the potential for mean reversion or a cyclical normalizing of the underlying low growth environment is less likely. And yes, we might have a cyclical upturn, but it's hard to see that get back to the sort of 3 to 4% GDP growth numbers that we need to get positive operating leverage out of many of these SA businesses. So for the last 3 years at Truffle, we've been quite concerned that SA is increasingly looking like it is potentially becoming a value trap with a low growth environment. Specifically talking about those businesses that have to operate and earn their money in an SA context. It's about weighing up, what the probability of a decisive intervention, which Sandile mentioned, we are direly is a extreme requirement that we need this decisive intervention now, which would result in getting some of this mean reversion or normalization. And I think in the absence of that, it means that investors are likely to pay less for SA assets because they have the ability to pick from a global perspective a whole host of other markets. And certainly a lot of other EMs and geographies don't have these constraints that we are currently facing. So I think that's the real tough question from an SA investing at many of these domestic shares. They look cheap, but are they in fact, value?
Very briefly, Ian, I think to appease the curiosity of many investors, has Truffle Asset Management increased its exposure offshore in the last 3 to 4 years?
So I think from a Truffle perspective, we over the last 3 years have very much had an offshore focus. We were quite concerned sort of 3 years ago, looking at a lot of data suggesting that there was a lot of negative operating leverage or earnings disappointments coming from SA companies, given the backdrop that you've sketched, and I think that everyone has already commented on. And when we did our analysis, we felt that the multiples or the prices being paid for many of these SA shares at that time were not discounting a future environment where we felt that returns and earnings outcomes for these businesses were unlikely to match what we'd seen in the previous 5, 10, 20 years, and had a bigger offshore focus. And I think, today, obviously, SA Inc. shares have meaningfully underperformed, and there are certainly some examples of where one is starting to get some decent value in that opportunity set. But I think it's very stock specific. It is not generic. And, to the extent that we don't get the structural reforms that Sandile spoke about, I think means that the playing field for many of these businesses is going to remain challenging. And, investors need to really understand what they're buying, the quality of the business, to put themselves in a position to generate the real returns which we all need.
Jacques, we're quite curious to find out from you as to what Prudential has been doing and your approach. Again, are you following in line with your counterparts in terms of buffering up the offshore exposure? And is this likely going to be a growing trend?
So on what Allan Gray has been doing, I would say you've got to look at the market kind of as two halves. So we got SA Inc. and we got big global companies that happen to be listed here. And over the last couple of years, you've seen SA Inc. being smashed. So just over the last 1 year, the Aussie's is flat. But if you'd only owned a basket of SA Inc. shares, that's down 30%. So those valuations have come off a lot. In the past, you were buying Standard Bank for 12 times earnings, Woolies for 20 plus times earnings, Growth Point at a 5% dividend yield. This is going back 5 years. But now those multiples have all halved, and Growth Point is at a 16% dividend yield. So they are pricing in a lot more downside. If SA turns out to be a Venezuela or a Zimbabwe or even a Greece, there aren't any good stocks in those countries. I mean, no one's priced, you can't price that in. But in most scenarios, I think you could get quite good returns from those stocks, and there is a place in the portfolio for them. Offshore, a lot of the developed countries, the US, UK, Japan, they've all got more debt than South Africa. They happen to be paying lower interest rates on that debt, but that might not last forever. Sentiment can change very quickly. And then there aren't that many very cheap companies in the US, for example. You do just a basic filter on, give me a company that's not massively over-indebted and that's trading on a decent dividend yield. There just aren't many of them. So actually, Orbis, our overseas partner, they're finding more value in emerging markets right now, despite the macro headwinds.
I mentioned Prudential there earlier, and I guess it's because we understand that we're speaking to three of the leading investment houses in South Africa. Sandile, we're keen to hear your thoughts here in terms of how Prudential has been approaching this particular strategy.
Thanks, Gugulet. I think, what Jacques mentions about the multiples that you're able to access currently are probably not multiples you'll see for a very long time. But you have to be very careful, and you have to be quite specific in the type of company that you're looking for, the balance sheet that you want, because at this point in time, balance sheet strength probably counts more than any sort of prospect that you can think of or imagine, right? So you need to have businesses that will be able to survive whatever's coming our way, in order to take advantage of, hopefully some upturn in economic fortunes. And look, once again, Jacques hit it on the nail. It depends where you look internationally. So, for us, developed market government bonds are a complete non-starter. We don't want to buy things that are guaranteed to lose you money if you hold them for any reasonable amount of time. So you've got developed market bonds trading at minus 1%. If you hold that for 10 years, you've lost 10% of your capital at least. So, what we're looking for are opportunities that are very similar to South Africa. So we're looking for emerging markets that, display a decent amount of growth within themselves. They can grow with very few self-help levers, but are trading at very decent valuations. So, that theme carries on even in bonds. So in bonds, we are, looking for opportunities where we're not exposed to interest rates going up, but we're actually being paid pretty decent coupons and pretty decent returns. And I guess in closing, I suppose one of the things that we're quite sensitive at the moment about is where each one of those countries' currencies are priced, because a lot of your return actually comes from how you translate those offshore earnings. So if you look at South Africa at the moment, if you're holding gold, global equities, you've earned something between 24 to 25% on a sort of 1 year basis. But of that 24, 25%, 20% has come from the rand actually depreciating. So, where the starting value of the currency is probably more important now than it was in the past, given where valuations have been.
So we very clearly highlighted the opportunities that exist in the offshore equity space, just opposing that in terms of valuations, both locally and internationally, and going back to company fundamentals. And there's something quite important that you highlighted here, Sandile, in terms of the bond market, is that opportunities perhaps still lie in emerging markets. But Ian, I want to throw this one at you to get your feedback, especially given the amount of volatility and ongoing economic concerns that Jacques also highlighted regarding emerging markets. How does South Africa compare against some of its EM peers, especially if you think of what's recently taken place with economies like Turkey?
Yeah. So I think the first point that we would make is that, we certainly believe that there is significant opportunities and value to be had in emerging markets. And I think if one takes a much longer term view, there's a lot of positive fundamentals with respect to some of the bigger emerging markets where they're managing to break out of that sort of middle income, or at least look as though they're emerging to sort of break out of that middle income space, where you can then see significant levels of consumption start to pick up and then services grow in those economies. And I think when one looks at the valuations for a lot of countries and geographies, there are a lot of very good businesses with decent franchises, decent balance sheets, and where valuations are actually fairly attractive. And I think that is one of the things that, from a truffle perspective, we've tried to capture in our portfolios, where we have been investing disproportionately outside markets like the US, where we are finding that very good businesses, which may not happen to be a tech business or a social media type of business, are trading on very attractive multiples, and where there's a lot of bad news that's priced into these shares. Now, I think your question in terms of emerging markets as well is important, is that not all emerging markets are equal. Some emerging markets have a high ability of becoming more developed, having GDP per capita rise meaningfully over time. And I think one needs to separate, I guess, those type of markets from the, let's call it, other emerging markets, which are struggling with some of the structural issues. And I think South Africa would fall into the latter category, as we've already discussed. So, I think when you're looking to allocate capital to emerging markets, as global investors do, they will look at the attributes of the market that they're wanting to invest in, like you would a company. In other words, what is the sustainable growth rate of this economy? What's the potential GDP outcomes? What's the education levels, the skill levels, the ease of investment, policy certainty, framework? All these factors lend themselves to, I guess, economies long-term manage to break out and become wealthier. And I guess, Singapore would be a fabulous example from the 1940s to today, being one of the most wealthiest countries in the world on a per capita basis, that has managed to achieve that. On the other hand, valuation is clearly important. So it's a combination of what prospects one can buy into. And we certainly seeing that, from an emerging market perspective, perhaps SA doesn't look as compelling in terms of its long-term growth potential versus some of these other emerging markets which don't have these same constraints. Now, we're certainly not saying that can't change. And I think as Sandile said, that if we see intervention across a whole host of different measures from an SA perspective, it would change the backdrop in terms of giving the companies listed here the ability to generate better returns and ultimately result in better returns for shareholders and clients. But, where we stand today and we look at all the emerging markets, SA doesn't look that attractive versus what I in some other markets which you don't have similar issues in so far as what we've already spoken about.
Let's talk about these issues, and I'm quite excited because for anyone who's been analyzing company results and trading statements that have been released in the last 2 to 3 months, it's been very interesting seeing the change in dynamics and the very bleak outlooks that we've witnessed from many South African entities. And Jacques, this gets me to the question regarding valuation for South African stocks. There's a huge concern in terms of where we see opportunity, which particular sectors are overvalued or undervalued. And I guess this would be very pertinent, especially given what we've seen of late with the rally in commodity prices. What would some of your insights be in terms of what you've analyzed regarding gold specifically, and also property, given the ongoing challenges we've seen in that market?
Okay, so specifically gold, maybe to start off with, if you will tell me what the gold price is going to do, then I'll just tell you what I think about the gold stocks. But it's a tough call. So for a long time, the gold companies were the worst businesses around, almost the worst businesses you could imagine. You just constantly be raising money from shareholders. Their cost would go up by much more than inflation every year. They just have endless problems. And the fundamental value of these companies used to just decline every year. But that's changed. So for since 2013, 14, those businesses started focusing a lot more on cash. And they become a lot more friendly towards shareholders, and they've just become better businesses. And you've had that now in combination with the fantastic rise in the gold price. So they are producing a lot of free cash flow. We're actually underweight the gold mining companies because they could still give you great returns from here onwards, but we are a bit worried that cost creep will start again, and that you kind of need the gold price to keep going up at quite a high pace for those businesses to keep producing constant profits for shareholders. We do own quite a lot of actual physical gold in the portfolio, but I admit that's a bit of speculation, right? It's very hard to guess what the gold price is going to do. It's largely a matter of sentiment. As Mr. Gray himself always used to say, the gold price, it's the ultimate speculation because the elasticity of demand is infinite and the elasticity of supply is infinite. People are just buying and selling to each other, this above the ground asset. And so that's gold. In terms of property, that's super interesting. So there's a lot of stuff that's busy unwinding. So a lot of strange structures that people have put in place. The hedging of foreign debt is a favorite that's going to have to unwind as the rand weakens. And that stuff has been boosting the earnings of the property companies. There's been too many malls built in South Africa and possibly too many offices built in Sandton. So those are all 5-year problems. But the sector, I think there's also a lot priced in. The valuations we're seeing in the property sector are very attractive. I don't think that these shares are so cheap that they're going to double. I don't think they're going to get back to the levels where they were. But for an investor with a 5-year period, you could get, I think, very satisfactory returns from some of the property stocks at the moment. And we do hold some of those.
I'm keen now to expand this conversation even further to hear from the other panelists as to where it is that you're seeing value, especially in light of what Jacques has highlighted. Some value maybe in the property stocks. Ian, would you share the same view? Sandile, and perhaps Ian, let's start off with your perspective in expanding into other sectors perhaps that might host great opportunities for investors to pursue.
Yeah, Gugulethu, I think that's right. And I think echoing what Jacques said is, I think it's very much stock picking as opposed to, saying sectors are cheap. And I think that's the first thing that, investors should be cautious about, is that not all businesses are the same and not all balance sheets look the same. Not all business models look the same. And I think there are certainly, from a property perspective, would agree that there are some assets, if you look at the centers and some of these assets, which are good quality assets, where the capital structure may have not been appropriate going into this, where now all the decisions that management are taking seem to be the right decisions. So cleaning up a lot of the financial imagineering in terms of how they've tried to boost distributions, and clean up the capital structure to the extent that LTVs are going to come down, and that you've got a sustainable amount of debt sitting behind those assets for what is likely to be still a sustainable business. So, and I mean, if one just looks at, for example, some of the big centers, Canal Walk, Hyde Park Center, there's some really good assets where financial structuring that was put into the businesses resulted in a lot of shareholder destruction in terms of wealth. But, ultimately there are some companies out there and some stocks where the assets are decent. There's a lot of bad news that's priced in. We're starting to see management make the right decisions. And I think that, like we saw in the miners, the big diversified miners 3 years ago, where, they pulled back on CapEx, started to become a lot more responsible in terms of looking at the hurdle rates of potential projects that they're investing in. You're starting to see that now play out in that property space, not across all businesses equally, but certainly we think that will continue. So from a stock specific point of view, definitely some opportunities where we've been nibbling. And I think equally in the SA Inc. space, some of the SA focused names, we think that there is an opportunity for big businesses with scale, which have got significant moats, balance sheets, and where management has displayed decent capital allocation over time, where we think they are likely to take market share from smaller businesses who are less able to cope with the issues insofar as COVID, and also where they will probably struggle in terms of financing and in terms of cash flows in this very difficult economy. So we've really focusing on businesses where there's a self-help story, something like an AECI, or businesses where we think can take market share, and we don't have to rely on the tide coming in terms of economic growth in SA to be able to generate reasonable returns. And we think there are quite a few businesses which are actually priced. But, once again, I think the theme that we're focusing on is very solid balance sheets. The underlying assets or business model must be a good one. In other words, it must be able to sustain health in time. And we think those businesses and those management teams are likely to add value. And then there are other situations, for example, like a Woolies, where you've got a great franchise. Probably Woolies Food, we would argue, is probably the best business in South Africa. Fabulous performance from that business, and you are able to buy it on a really, really cheap multiple, where you are now seeing, certainly if Truffle believes that we're seeing steps that are being taken that are going to unlock value in the future as far as management potentially divesting themselves of some of their troublesome assets. So, I think it's once again what I said at the outset. This is not a generic type of call. We can't just say from a sector, this sector looks cheap, that sector looks expensive. It really gets down to doing your homework, looking at the shares, looking for those catalysts, understanding what we're paying for those businesses, and then comparing it to the value and making sure that there's a significant of safety, which then starts to translate into better prospective returns for our clients, 2 to 5 years down the track.
Makes a lot of sense, especially given the recent environment that we've seen with some consolidation in the retail space, others pulling out of particular markets that they might be operating in. So clearly, a lot of companies having to be very strategic with unlocking more value from their balance sheets. Sandile, I saw you nodding quite a bit when both Jacques and Ian were sharing their themes there. So we're quite keen to hear how Prudential has also been approaching this particular strategy and change in environment.
Yeah, thanks, Gugulet. I mean, to be honest, there's not much else to add to Jacques and Ian's comments. I mean, we sort of, taking on from my sort of more qualified colleagues on the gold and property front, we are underweight gold stocks. As Jacques mentioned, we've been worried about the ability to pay us cash flows because, as he mentioned, any money they make, they have to sink back into holds to basically maintain their production. So there's not much else left for shareholders. And we don't hold any physical gold. It's really been an asset that we've really struggled to think about for the longest time. And really, things that don't pay you a yield or pay you a negative yield in the case of gold for a long time are really hard to sort of think about and sort of rationalize as inclusion into the portfolios. I will say, though, gold has a particularly interesting quality in that, in a lot of times of stress, people tend to want to run to some sort of safety. And historically, that's always been, developed market bonds, particularly US Treasuries and German bonds. But now that you have US Treasuries, inflation-linked Treasuries trading at negative yields, the sort of negative yield argument that sort of creates a blind spot for you for gold is basically out the window. So, the opportunity cost of holding gold is now not particularly penal. So, it's interesting from a portfolio perspective in that it helps you protect your capital. And yeah, from a stock perspective, we simply haven't liked the businesses and the quality of cash flows coming out of those businesses. Property is very interesting. I mean, COVID has really just accelerated a sort of structural theme we've seen play out in other markets. So people, have stopped going to high streets. You look at the UK. I mean, Hammerson has just come out, with a pretty penal capital raise that they need to shore up their balance sheet. And COVID has simply just accelerated what would have taken 5 years into a few weeks. But having said that, once again, as Ian mentioned, there are stocks that will benefit from less footfall, less human traffic going into and out of offices, going into and out of malls. So, a typical example would be a logistics company or a company that owns warehousing space. You can imagine, where Amazon is and other online retailers are taking an even bigger proportion of retail spend. They will need bigger spaces to store the stuff they need to ferry from where they're being produced to where they're being delivered into our homes. So those sorts of property companies, are probably going to enjoy a pretty decent growth prospects going forward. So it is really about understanding and picking the right stocks.
Understanding and picking the right stocks. And I think what all of you have highlighted is the pressure that South African businesses in the private sector have been under. And that also leads to a lot of concerns that we've seen within the public sector. All I need to say is SABC, SAA, Denel, Land Bank. I think the list can go on. And this has raised a lot of concern and challenges in terms of understanding the correlation of prescribed assets, as we've seen it constantly coming up in the markets in terms of an argument point and government trying to look to implement this to ensure that there is a mobilization of private capital that can support government institutions. So I guess a twofold question here to yourself, Sandile, Jacques and Ian. It would be grateful if we could hear some of your views as well, very briefly, as to how do you see this being rolled out, and are there any advantages or disadvantages to the argument of prescribed assets being reintroduced to the table, and how we need to adequately manage our failing SOEs?
Oh, Google it. That's a prickly question, but yeah, I'll grab it by the nettle. Look, I think if you think about it, if you have kids on the playground and you let them run free, they can express themselves and probably tire themselves out and hopefully sleep well at night. But if you sort of put barricades around those kids, you create artificial barriers, and that's all prescribed assets are. And South Africa has actually a pretty long history with prescribed assets. We had a prescribed asset regime for about 30 years, from the sort of late 50s to the late 80s. And it culminated in the sort of Jacobs Commission. And the Jacobs Commission's recommendations of sort of 1989 was effectively the abolishment of prescribed assets. And when you think about the barriers and the cost, the opportunity cost of prescribed assets, what the Jacobs Commission found was, prescribed assets are effectively a stealth tax on savers. So you lose between 1% and 1.5%, according to their calculations, in opportunity cost, because you're unable to access what you would otherwise want to access. And the second thing they found was that, really sort of so crowding capital into one sector artificially starves the rest of the sectors for capital. So, businesses that would have otherwise been able to access capital cheaply either weren't able to access capital cheaply, or they weren't able to access capital at all. And that itself creates an opportunity cost. And I mean, we speak about prescribed assets, but at the end of the day, we're talking about people's savings. So, my mom has just retired. She's got a pension pot. I can't say to her, look, I think you need to take 50% of your money and give it to Eskom. Because the first thing she's going to ask me is, how on earth is Eskom going to pay me back if they can't even keep the lights on? So I think we have to be very, very careful and quite responsible about how we think about marshalling the capital that we have, the scarcity we have in the country, to sort of create the best opportunity to maximize. If we do embark on structural reform, part of that is that we'll need to be building capital assets to allow the economy to increase its potential growth rate. But structural reform in and of itself, with prescribed assets, can actually be a good thing. All we're asking, or all we think people should be thinking about, is ensuring that the capital, where it is deployed and where it actually is allowing the economy to grow and grow more efficiently, allows savers to actually earn a sort of decent enough return. Because at the end of the day, this isn't our money. This is people's hard-earned pension funds.
You're quite right. It's a very pertinent issue, and one that does need to be addressed quite adequately in making sure that returns are still maintained. And I guess that brings us into the closing remarks and conclusion of this panel discussion, as there's been so much value to extrapolate. And it leads to an understanding as to, where do you see the future of South African investment? Do you believe that there are still growth opportunities? How do we tackle them? And most importantly, for South African investors to perhaps alleviate their fears in providing them with words not only of encouragement, but words that speak to strategy that they can execute in terms of understanding how to manage greed over anxiety, as well as sticking to a long-term investment plan. Ian and Jacques, I'd like to give you both an opportunity to respond to that very briefly, if you can. Ian, let's start with you. Jacques, you'll follow through.
Thanks, Gugulethu. I think from a long-term perspective, I guess, as I said at the outset, is it's important to, stick to your plan, and to also to realize that, even in economies where you are faced with a lot of these issues, assets can discount a lot of this bad news, which gets back to the point which we really started with, was valuation and the intrinsic value. If you're able to buy into the value of an asset for if it's worth 100 cents, and you can buy it for 50 cents, and if you hold it for long, you're likely to generate the returns that you need. I guess the big dilemma that we're all facing right now is, what is that value? What is that 100 cents? Because the factors that are influencing the value of many SA assets are tied to a lot of the decisions and the steps that need to be taken in SA today to make us sustainable. And I think, all the panelists today, everyone has spoken, I guess, about the challenges. I mean, Sandile has just spoken about our SOEs, which are drawing extraordinary rents from the SA taxpayer, to the extent that these businesses are not going concerns. And what this does is, it makes SA businesses uncompetitive, and it consumes disposable income from consumers, where we are all paying 15-16% per annum increases in electricity, but I can tell you my salary increase is not 15 or 16%. And if you get 3 or 4%, you're lucky. So where does that money come from? And I think that's what Sandile is saying, is that we need decisive political intervention to stabilize SOEs, to create policy certainty, to create an investor-friendly framework which will provide the opportunity to unlock value in some of these SA assets which optically look cheap. And I'm specifically saying optically because you need some of these things to happen to unlock that value and get some sort of mean reversion. So we are very much data dependent. The data at the moment suggests indecisiveness, inaction, and we are fast approaching the point where the fiscal demands in terms of public sector wage bill crowds out productive capital expenditure. And I mean, I'll give you a stat which might scare some of the listeners today, is that South Africa does not even spend on our capex the amount of depreciation which you would expect to be spent on an annual basis. So it means the quality of productive assets every year is declining. And I think these are the things which at Truffle we want to see addressed. And I think that will then give us the opportunity and SA investors to be part of a more inclusive economy where there is value creation for all, and ultimately then I guess results in a brighter future. So all these things are possible. So we're not saying they're not possible, they're certainly possible. But I think that's the conditions you're going to lift all the boats. We certainly believe that there are some opportunities in SA where there's a lot of bad news priced in, but it is very much on a stock specific basis. This is not a generic comment we are making. So yeah, I think there's a lot of uncertainty. Let's look at the data, but it all comes down to valuation and the price we're paying for those assets. And that's where we're trying to do our work to ensure that there are margins of safety for our clients and that we put them in the best possible position to earn those real returns they need.
Jacques, your thoughts?
So I would say stick to your plan, diversify, and take calculated risks. I don't think now is the time to go absolutely all in on SA Inc. That bet could pay off very well, but there are lots of scenarios where you lose a lot. So I would say it would be good to have a diversified portfolio and allocate your risk carefully towards SA stocks.
I think you've all provided a very great overview in terms of how best to approach the market dynamics. One often thinks of the Warren Buffett quote, when there's a time when people are greedy, others are fearful, and when others are fearful, others are greedy. But fundamentally, none of these emotions should be driving our investment decisions. It really is about a thorough investment plan and one that sticks out to the basis of valuations as well as the long-term objectives that investors have. A big thank you to each of you for joining us for this conversation and setting the tone for what it is that we want to explore. So to Ian, Jacques, as well as Sandile, we're appreciative of the feedback and insight you've shared with us today. The conversation does not end here, though, because we have invited our participants to share their thoughts, participate in the chat service, as well as highlight an overview of some of their questions, comments, and concerns, which we will be addressing shortly. So to either of you or any of you in the audience who've participated in sharing your questions, thank you so much for sharing them through. Do be advised that these questions have been moderated just to ensure that similar themes can be easily incorporated to ensure that the panelists are able to respond to them. With that said, perhaps let's explore some of the first questions that have been brought on board today. While I see that you've been keeping us busy with many of the questions that you want our panelists to answer, but before we deep dive into some of the suggestions and comments that you've offered, we do want to remind you that a full recording of today's virtual event will be made available to you as registered participants at the end of today's function. So please do be on the lookout for that email correspondence, which will be shared with you to continue viewing this particular webinar within your own time. But let's get into the questions, and a reminder of our panelists who will be offering their time to respond to the questions that you've offered here today. Jacques Plout, Portfolio Manager at Allan, Ian Power, Portfolio Manager at Truffle Asset Management, and Sandile Malinga, who joins us as a Portfolio Manager from Prudential. Well, let's deep dive into the first few questions that we have from many of our guests who have been watching this particular function. And I'd like to start off with the first question to you, Ian. Why are growth stocks still outperforming value stocks internationally?
Gugulethu, I think that's quite a big question to answer, but let me try and break it down into, I guess, the components how we try and understand it. So the first thing to note is that when one looks at, what is growth, many of the big mega tech companies which have really structurally disintermediated certain industries where they are taking market share on a structural basis, that has continued. So I think that positive theme has attracted a lot of money into these shares now, where you are seeing multiples which are now expanding to levels which have driven many of their share prices, in Truffle's opinion, to areas which are well above their long-term intrinsic value. So I think, growth, because there has been, I guess, earnings which have been generated from these businesses, people have tended now to overpay for those earnings. And I think, the risk is now that those lofty multiples for many of these shares now start to unwind. And when one just looks at the extent to which tech has now got a disproportionately large size in terms of its weighting in the indexes, that has been dragging many of these growth indices up. And I think that's probably the first answer to the question. The second answer to the question is, because of the environment that we're in, where you've got financial repression and you've got negative real interest rates are at sort of zero, oil prices have collapsed, sectors which weight or have higher weightings in the value indices like materials, like banks, financials, and some of the energy companies, they are battling with some of these difficult, bigger macro backdrops. And I think, to the extent that those, let's call them value sectors, need the broader economy to grow and to get pricing pressure, in terms of their underlying products, they haven't been able to do that in this disinflationary environment. But I think therein lies the opportunity from a Truffle perspective, where we see many of these traditional, old type business models, which might not be tech, it might not be sexy, but it is certainly cheap to the extent that they are trading on pretty low multiples. In some cases, you can get very attractive dividend yields with still some decent growth. We think that there are a lot more better prospects to earn returns in that pond, as opposed to some of the high-flying tech growthy type businesses, where we now see significant risk in terms of multiples that could contract if the lofty earnings expectations are not met, as and when these businesses report over the next couple of years. So I think that would probably be a quick overview. And then finally, just to say that, yields and yield curves around the world, and I think, Sandile has already mentioned that bonds look very expensive and certainly not a place to be putting capital into to protect your assets. If those yields move up, even by 1% or 50 basis points, some of these long duration, high growth companies, we think, could experience quite a vicious sell-off. So I think it's quite a dangerous time now, we would think, to be long some of these mega cap, big growth companies, because multiples are extended, and because some of these factors which have driven this level of outperformance could in fact start to reverse.
Clear direction there, and thank you for that feedback. Jacques, I'd like to come to you with quite a full question, especially given the times that we're in. But the question asks, what role does ESG play within your investment process? How seriously do you consider the impact of your investment positions on the broader society and environment? Is this primary thought or perhaps a nice to have?
Yeah, thanks, Gugu. So there are really three questions there, because government ESG is environment, social, and governance, and they're quite different things. It's much easier to talk about governance, and there I would say you almost can't overestimate how important this is to valuing a company. And when we've made big mistakes, it's often been because it's been a cheap company, but with a weak board, weak oversight, or poor management, and that ends up scuppering the prospects of the company. So whenever we discuss a company, when we write a report on a company, we have a full history of each director, and we spend quite a bit of the discussion on evaluating the strength of the board. And just to give the listeners one solid data point there, last year we recommended to our clients to vote against 6% of the directors that were up for election. And then moving on to the environmental part, and the easiest example there would be Sasol, where we've been on Sasol's case for years, trying to get them to publish a firm plan for how they're going to reduce their CO2 and sulfur emissions, and also a timeline. And last year, finally, that happened. I'm not saying it's only because of us, but we think that's a role we can play as a responsible shareholder to encourage companies to do the right thing. And then lastly, maybe one example on social. 3-4 years ago, we weren't buying any Eskom bonds for our clients, even the ones that were guaranteed by the government on a nice spread, because we felt at the time this was just money going straight into the hands of the Guptas. So we made a principled decision there to forego that slightly better return for our clients to do the right thing.
I'd like to follow up on that one very briefly there, Jacques. And when you mentioned the elements of governance, I automatically thought of companies like African Bank, Steinhoff, EOH, Tongaat, to name a few in the domestic environment. Would you say the lessons we've learned from these companies in the last few years are now perhaps setting a precedent in terms of how Allan Gray and some of its peers are approaching investment strategies in terms of governance, particularly in the domestic environment?
So interesting, Steinhoff, one of the bull cases for Steinhoff was how strong the board is. They had a lot of very credible, highly qualified people with good track records on their board. Often you'd tell people, I would make the Steinhoff bear case, and someone would say, well, Christo Wiese is the chairman. He wouldn't do a dumb thing. He wouldn't invest in a scam. So Steinhoff is an interesting one. But yeah, definitely, I think you learn through these kind of mistakes. So African Bank would be a good example. They did not have a strong enough board, and that board didn't exercise its oversight of the accounts responsibly. And those would be good examples of directors that we would not want to see on any other board ever again.
Thanks for your feedback on that one. Sandile, let's come to you to get some insight here. And this one again focuses on the global bond market environment. The question asks, do global bonds still offer value for South African investors in a balanced portfolio? How do you invest conservatively offshore with cash and bond yields at all-time lows?
Yeah. Thanks for that question, Googlets, and from the listeners. Look, I think for us, the most troubling thing about global developed market bond and Ian is, the negative real yields that they're trading at. So you've got 10-year US TIPS, which are inflation protected securities trading anywhere between minus 50 basis points to minus 80 basis points. If you hold that, as I mentioned before, for a reasonable amount of time, you're guaranteed to lose money, and you're going backwards in a real. We wouldn't say that's a conservative or even a safe way of investing. What we would say, is that some markets still offer you sort of real yields. So you can look at markets that look like South Africa but aren't really like South Africa, and safer, better economic prospects, and will offer you a real yield. And hopefully, in doing that, you're helping diversify your portfolio, but also you're still earning some sort of a real yield. So global developed market bonds definitely do have a role to play still, but you have to be quite careful what you're buying.
Careful what you buy. When you mentioned the EMs there, I was tempted to ask you as to which particular markets were you referring to, especially given the current news headlines we've seen in terms of the likes of Turkey and how that's had an impact on South Africa as well as the emerging markets. So for the benefit of the listeners and viewers, care to name drop there?
Sure, with pleasure. Look, Turkey is a particularly interesting market, and it's one that I've traded in the past and I've looked at for some time. And really, what's happening in Turkey gives you a guide of how emerging markets, even though they've got robust growth with poor management, can actually go catastrophically wrong. So Turkey is definitely not a market that we would be looking to include in the portfolios. It's quite interesting. We have had Turkish bond exposure in the portfolios before, but that was, if you can recall, 2 or 3 years ago, when the market was getting worried about Turkey's balance of payment position and its ability to basically access hard currency post US sanctions, Turkish bond yields sold off quite dramatically, and that was something that we're quite interested in. But it was quite clear it was a tactical trade, and it wasn't something that we want to include strategically in the portfolio. As it stands, Turkish yields are elevated, but they do come with significant risks. So Turkey, unlike South Africa, doesn't really have a credible central bank. So you can even see in the market's inflation expectations have become somewhat unhinged. And, even if you're getting what looks like a reasonable nominal yield, that can all be eaten away by runaway inflation. A market that looks quite interesting and still offers you pretty decent real yields. You can look to Mexico. It's quite similar to South Africa, has some troublesome SOEs. So you can hear the theme is quite the same. Markets where you're getting compensated relatively high real yields are markets that typically are accompanied by bad news. Our assessment is to try and understand whether that bad news is priced in and if you're being compensated for it.
Makes a lot more sense there. Well, now, moving from the bond market more to the equities environment, and this is a built-up question both for Jacques and Ian. The question asks, as markets have recovered, is there an anticipated downturn because of the fundamentals post-COVID-19 worldwide? Ian, if you can give us feedback, and Jacques, how you're approaching this one from an Allan Gray point of view. Ian?
Gugulethu, I think you're right. Markets have had a massive recovery, and the speed of the recovery certainly surprised us at Truffle. But I think it's also important to recognize that the speed of the policy response was equally large and unprecedented, across many different scales. So, from a market point of view, I think I'm happier to, I guess, delve into prospects and return prospects for certain companies. But I would think that many of the big index weighted shares, and certainly if we look at the S&P and the US market, where we think some of those valuations are really looking stretched, and we are into our second year where we think S&P is unlikely to grow earnings. And yet those multiples just continue to expand to the moon. So I think markets are certainly priced for a faster normalization to pre-COVID levels of economic growth. I would think that looks like it's in the numbers, and particularly in the US. But obviously there are always exceptions and value opportunities to be had. I think the inevitable vaccine announcement no doubt will come, and that could add a little bit more fuel to the fire. But ultimately, earnings will drive share price performance over time. And if you break down returns from look at the return algorithm of an index or a company, it's made up of the dividends, the reinvestment of dividends, and that sustainable growth rate, and then there's a valuation component. And I think the valuation component at the moment to us is starting to flash a little bit red, particularly from a US point of view. So I wouldn't be surprised if markets went sideways or derated, from these levels to the extent where earnings catch up with some of the lofty multiples on some of those big shares. I mean, having said that, does that mean that you can't get a sharp rally in some of the under-owned, bombed-out shares, financials, energy? No, I think there's certainly opportunities. And I think, as we've said earlier, in emerging markets, a lot of opportunities. And I think it's once again a very stock-specific picking environment, as opposed to looking at these big, broad indices and perhaps getting, dangers being sucked into some of those big mega cap stocks, which are, in our opinion, discounting, earnings which are unlikely to be achieved over the next couple of years.
Jacques?
So this is one of those things, if enough people are anticipating a downturn, it'll happen now, right? Not in the future. So we look at the valuations, and I think there's quite a lot of risk of losing money now in the developed markets because I don't see a lot of cheap stocks there. But I've got to be honest, I would have said the same thing 5 years ago and been dead wrong. So take it where it comes from.
Jacques, I'd like to stay with you for just a moment. And I think for many investors, we see the news headlines, we've been monitoring the company earnings. But one thing that's been difficult to avoid is the geopolitical tensions that we're seeing specifically between the United States as well as China. Whether it's Trump versus TikTok, what that means for our exposure through Naspers via Tencent, and of course the ongoing challenges as we are counting down to the US elections come November. What do you make of this dynamic and the ripple effects it might have on markets and the exposure for South Africans who have both a balance of investments domestically and, of course, offshore?
Yeah, so the big worry with that trade war is Naspers. We've seen British American Tobacco, to talk about something different for a second. The share has been under quite a lot of pressure for a few years now. And one theory about that is that it's caused by sustained selling due to ESG concerns. Like a lot of large pension funds are selling out of tobacco stocks. And if all US investors were forced to sell Tencent shares, that could cause years of pressure on Naspers, or maybe it'll all happen very quickly. So that's kind of a technical concern for us. Obviously, Naspers' fundamental value won't really change if that happens. And we don't think that's very likely either anyway. So Naspers, it's largely domestic in China business, so we're not too worried about the trade war on that front. Thinking sort of a bit further on, the demand for commodities, all that kind of thing, it could have broad effects, but it's really hard to assess what those effects might be, and then to think, okay, well, how does that play into the valuations? So it's a tough one.
A tough one, but I guess we play it by ear and monitor the situation, crossing fingers that nothing too dramatic happens in the upcoming months. Sandile, we wrap up with you with the last question, clearly from a South African who's very concerned about the recent developments we've seen in terms of the rising debt levels in the country. The question asks, the debt mountain is just growing and growing. When is the day of reckoning?
I hate to be a bearer of bad news, Gugulet, but I think we're way past that. One of the consequences of, sort of rising debt levels is that at some point people assess your ability to pay them back, and if they don't like what they see, then your interest rates are going to continue hiking, and it's effectively probably going to hasten what would have taken a few years into a few months. And by our assessment, South Africa is there. So South Africa is paying between 7 to 8% nominal on its debt. Whatever we're issuing at high and high interest rates. And if you do a quick sort of growth accounting of what's contributing to the rising debt level, at the moment, the biggest increase is obviously partly due to the wider budget deficit from the COVID hit, but really what's happened is that we're baking in high and high interest rates into our debt. So I would say the day of reckoning is well and truly behind us. How do you fix it? Well, it's almost chicken. You first need to deal with your budget balance, and then interest rates should come down as people's confidence in your ability to pay them back increases. So what we'd like to see, maybe sharing some of our hopes for upcoming data, is really for South Africa to demonstrate that quite serious about addressing our unsustainable spending mix. So if we can, demonstrate that we will be bringing down how much we spend versus how much we actually bring in, and do it in such a way that, as it stands, we're not spending, as Ian sort of mentioned, we're not spending enough just to basically replace the capital that would depreciate in a year. So, the wrong thing to do would be to basically cut infrastructure spend in a bid to sort of rein in our budget. What we would say is, something which is incredibly politically difficult, it would be to look at how much we spend in terms of public sector wages. And really, if you can demonstrate that you, some way or another, are not going to be giving people unsustainable increases, because really what we're saying is that the country can't afford to tax 16 million people only to pay 1 million people increases that the rest of us aren't getting. I don't think that's the right mix of policy and situations for us. So if we can get that, I've no doubt in my mind that the high real yields that we're seeing will collapse. We've got a classic example. Brazil was exactly where we were 2014, 2015. Unsustainable budget mix, unsustainable spending mix, incredibly rigid budgets that bake in real increases. And if your economy is doing that, you simply can't afford it. So, we need to rebalance that. And as soon as we can rebalance that, I think in 6 months' time, we'll be having a very different conversation. We'll be having a conversation about what it is we actually want to do with the economy in order for the rest of South Africans to actually be able to participate in a meaningful way.
As you mentioned earlier, it calls for some really strict and robust reforms, and we're certainly looking forward to what the midterm budget policy review will share with us in terms of October with the finance minister as he takes to the podium in the upcoming months. Well, we thank you for participating in this Q&A session, to each of you as panelists, and for sharing a more insight with us, especially for our viewers. And to those of you, as mentioned, we haven't been able to get to all of your questions. However, we will endeavor to ensure that we respond to your questions post this event. Well, as we've come to an end of this first virtual event of the Independent Insights for 2020, I definitely like to extend my gratitude to our guest speakers, our stakeholders, and to many of our partners for allowing us to have the opportunity to engage in such robust conversation that has certainly led to increased interaction and a better understanding of the investment landscape in South Africa and beyond. We trust with this increased engagement and conversation that takes place that many of you as investors are left feeling slightly more confident in understanding the lay of the landscape, as well as some of the pressures that will be placed on government to implement the correct and necessary reforms, which will ultimately lead to the economic growth that we seek, that will result in viable investment returns for all participants in the market. I'd also like to extend my gratitude to Allan, Prudential, and Nedgroup for creating and hosting such a unique platform, which has allowed us to engage in many of the independent insights that have been shared here today. I'd also like to take the time out to thank each and every one of you for participating and viewing today's conversation. We certainly appreciate your feedback and appreciate the interaction that you've also shared with us here today. We look forward to interacting with you in future and again, gauging where your level of confidence is in terms of the investment arena globally. From myself and the team, we wish you nothing but a profitable day forward. And most importantly, take care and keep safe.